Good afternoon. Welcome to today's Wednesday stock market stream. My name is stockdarts, and we're going to do the usual. We're going to look at the four major markets. We're going to look at the S&P 500, the Nasdaq Composite, the Russell 2000, and the Dow Jones. And once we finish looking at those four, we'll take a quick look at the U.S. dollar. We'll look at gold and silver, and we will also take a look at some chart requests. If you guys have anything that you're interested in trading, or maybe it's just a chart that you have a question about, feel free to put it on there. If you like what you see today, if you enjoy my analysis, feel free to stop by and follow me on Twitter at StockDarts. You can go to YouTube and look for me at StockDarts as well, or you can go visit me at patreon.com/StockDarts, where I post weekly content, some trade ideas, some watch list stuff, and usually repost these Wednesday webinars or Wednesday streams. We've been having some trouble with ticker.tv keeping the streams up. So what I'm going to start doing is recording them and putting them back on YouTube and back onto my Patreon page. So hopefully that'll work, and we'll have an archive of today's session moving forward. Other than that, let's go ahead and get started. Keep in mind, if you type a question, there seems to be about a 10-15 second delay, so if I'm a little slow to answer your questions, it's because I'm seeing them a little bit later than I think you typed them out. But feel free to put them in there. Like I said, put your chart requests in already, so I have an idea of how much time we need to allot towards the charts that you guys are looking at. Other than that, let's go ahead and get started. Let's take a look at the S&P 500 first. And we're going to look at a chart of the ETF SPY. And we've had a pretty productive last few weeks, right? You can see that we've cleared some pretty important resistance levels and are slowly inching our way higher, and things are pretty bullish. If we look at a weekly chart, just get a general sense of what we're doing in the longer term, you can see that we are breaking past a pretty important range that we've been stuck in for a while now. We've been trading sideways for the most part since really the middle to end of 2017 and mostly 2018 and 2019. And while we did have a break to the downside, we are now attempting to break out to the upside, and we'll see whether, it's still early to tell whether this is going to stick or not, but things are looking pretty strong and pretty positive, and I'd say right now a lot of signs are pointing towards a renewed move up in the stock markets as we head into the second half of 2019, and particularly once we finish through summer and start heading into the winter months, or fall and winter. But for now, what we're looking at and what we're concerned with is how we navigate this breakout that we're seeing and how we go ahead and hold it and confirm it. The big question right now isn't how much further we can go up, but what happens once we pull back? Are we going to pull back and hold above this 292 range, or are we going to fall back into the range that we had previously, in a mirror, sort of a mirror image of what happened at the end of last year, beginning of this year, when we broke down through the range and came right back in. I've been alluding over the last few weeks to the similarities between what we're doing now and what we saw in 2015 through 2017. And you can see what we did last time was we broke out and eventually we held and kind of confirmed that breakout through the process of trading above the previous range for a period of about 2 or 3 months. And that's kind of what we're starting to do right now. And the question is, again, when we eventually retrace this move, are we going to confirm this as a positive breakout, or are we going to start to trickle back into the previous range? And I think that's still up for debate, but we'll see what happens. Keep in mind, we are now in the beginning of a new earnings season. We've had some airlines and some financial names report recently, and we have Netflix and IBM reporting today. We have a few, some of the other bigger FANG stocks reporting the next couple of weeks: Apple, Facebook, Amazon, Google. So we're going to have a lot of earnings news that could impact the markets and could eventually decide what the short-term direction is for us as we close out the rest of July and head into August. And we'll see what kind of impact they have. But more importantly, I want you to keep in mind, when you are trading, make sure you pay attention to what the earnings report date is on any name that you're looking at, because it could end up exposing you to a lot of unanticipated volatility if you take a swing trade thinking you're just going to put your stop somewhere and trade a name long or short, and not realize that it has earnings, and if it does, it could gap right below your stop and expose you to a lot more risk than maybe you anticipated or were expecting. You, what do you mean you see nothing, Ray? You don't actually see the stream? Do you hear me? Because I see the stream on my screen. Alright, please excuse me for a second, just typing some questions for Ray. Alright, so what we're seeing here again is a nice climb above our previous level. I do want to point something out. That is a slightly bearish pattern, and I only mean this in the short term, and it's only a potentially bearish pattern, but we are starting to develop a little bit of a rising wedge, right? And it could, at the moment, it could even just be considered a rising channel, which isn't quite as bad as a rising wedge, but you could take a look at it like this, right? You can either draw your trend line like this, or you could do this. I think I'd rather just do this for now. And for the most part, it encapsulates what's happened as we've broken through this 292 area. And what happens here is that the longer this goes on, the more likely the chances are that we eventually get a sharper drop through. However, that drop could end up leading to just a retest of 292. So I don't think it's anything particularly dangerous right now or particularly frightening. But it is something I want to point out in the short term. If we start to struggle here, once we lose this wedge, we should come back and test the 20, and more importantly, probably come down and start to test that 292 range again. I think the key right now is very similar to what it was a few weeks ago when we were discussing the price action, which is we want to now maintain price action above 292. The first time we tested it, I didn't think it was that important. If we failed the original test, as long as we stayed above our moving averages and came back up and tried to make our climb back through that area, it would have still been pretty bullish. But now that we've actually had one very short-term test of that and continued higher, we don't want to have a test lower than the previous test, right? So if you're ultra bullish and you want to continue to see the market continue to climb higher, you probably don't even want us to lose this 295 range, which was the previous little drop that we had. But I don't consider that a major level or a significant level, even if it is pretty close to the previous all-time highs that we had in May. I think what's really important here is when we do fall out of this wedge, that we sort of respect the 50-pair moving average and this 292 range. In the short term, we might just respect the 20 period and end up sort of just continue to climb higher and lose this pattern, but continue a sort of a broader climb through a steady move up with the moving averages. And if that's the case, then we'll see the 20 period sort of buoy the price action and support it. But I suspect that when we do lose this wedge, we'll likely fall below the 20 period. And the key again is, as long as we don't lose 292, I think we're okay. If we do lose 292, it's not necessarily bearish. I don't think it's indicative of a market top, but it could mean that we need to spend more time in the broader trading range that we spent the last couple of years in. And if that's the case, we'll eventually see price action lose the 50 and come right back down and start testing some of these lower areas. Now, if that happens, I think the major line in the sand that we don't want to lose right now is 280. It's the same price point we discussed a couple of weeks ago. And it's a critical area from the end of last year, and really was the only major price point that had a lot of testing this year. You'll notice as we started the year, we climbed pretty steadily from the lows of last year, and we spent maybe a week testing this 263 area. And then eventually found some resistance up here at 281 to 282, where we spent a good 2 or 3 weeks below it, and then another 2 weeks or so above it, and eventually climb higher. Then the first time we had a real sharp retracement, we came right back to that area. Now we did probe a little bit below it, but we eventually were able to reclaim it. And once we did reclaim it, that's what started this new run that we've had now to new all-time highs. And the question now becomes, when we do pull back again, if we do lose 292, do we come back and test that area? If we do, as long as we hold above it, well, then this sort of upwards trajectory remains intact. A minute ago, I was discussing this idea that you don't want to lose ground, and you don't want to lose the retest, the previous retest, and so you don't really want to lose this retest. But if you think about it, that's just a minor probe into previous support. This is a much more important series of price tests and price action. And I think that this is really the key we don't want to lose, is this retracement that we had that began in April and sort of culminated with the beginning rally that we had as we started June. And I think that that's ultimately the longer-term price point that we really want to concern ourselves with on the S&P 500, is maintaining price action above 280, above the 200-pair moving average, and just generally not losing or canceling out this retracement that we had a couple of months ago. And I think as long as we stay above that, then I think in the long term things are still very healthy with the market, and I think are still pointing towards a longer term move to the upside as we start to head towards the second half of this year and closing out 2019 in the next 4 or 5 months. Now, to the upside, there's really nothing I could point out, right? Because we're at all-time highs were the highs, the price action from 3 days ago. But for the most part, there's nothing really that we can point upstairs other than just looking at theoretical resistance. And so I'd say for now, what we really want to concern ourselves with is risk reward and making sure that we are keeping track of where we're moving, and more importantly, what happens once we get to those price points. As far as trading is concerned, I don't think the risk reward is great here. When I summarize the 4 major markets, I'll give you a little bit more of an idea of what I'm looking to trade and what I'm thinking of as far as trading is my trading patterns altogether, as far as what I'm doing this week, what I'm going to be doing the next couple of weeks. But if you're just looking at the S&P 500 in a vacuum and you're trying to figure out how would I trade this, I'd say right now is not a great time to go ahead and trade it. You don't really want to short it because it's very strong, but you don't really want to go long here because we're kind of caught in a spot here where the risk reward's not that great. Now, if you're trading very short term, what I mean by very short term is you're day trading or day trading 1 or 2 days, you might want to trade the support of this wedge and continue trading the noise as it bounces back and forth in there. But you have to be very, very short term oriented, and you have to be very quick about what you're trying to trade if you were trying to take that. For most people that are just swing trading and trying to take advantage of what the market's doing, you have to be real cognizant of where we are right now in the bigger picture and understand that while we are climbing higher, it's starting to get a little bit tired. You can see that the range is getting tighter as these two trend lines start to converge. You notice volume has been slowly decreasing, showing that we're starting to lose a little bit of momentum as we continue to climb higher. And this divergence here, where price is going up while volume is going down, is telling us that there's a pretty decent chance that we will eventually have to fade back once volume starts to kick in. Now, of course, it could be different, right? We could eventually rise and continue climbing, but the risk reward is not good here. And I think that's more important right now than trying to guess the right direction. I think a lot of times traders get caught up in trying to get the right direction and not understanding that what they can control is the amount of risk that they are accepting versus the amount of reward that they're trying to get. We can never really control whether a stock goes up or down. And I think that's a realization that really needs to be made if a trader wants to turn the corner and become a little bit more profitable or just have a better success rate, is understanding that you do not really control whether a stock can go up or down, right? It's really a game of probabilities, and what you need to do is stack the odds in your favor by controlling your risk and your reward and making sure that you understand the best timing and when it's a good idea to get in. And typically you want to do that when you're at a good level of support, not necessarily bottom fishing. I think a lot of traders, if they say, well, I don't want to trade weakness, I want to trade strength. Well, you don't have to look at a long-term support value, support level, and say, well, I'm buying the bottom. You need to find a support value within a certain time frame or within a certain pattern, um, and try to stack the odds in your favor that way. And I think right now, again, the odds really aren't in our favor as far as trying to go long here, but they're also not in our favor to the short side because the strength is it's too much strength right now to really go ahead and try to get cute and try to time a short because there's a lot of buying that's still kind of underneath the surface waiting to sort of take place, and there's still a lot of demand that we need to chew through before we get any kind of substantial pullback. Now, if we take a look at the NASDAQ, you'll notice the same sort of pattern as the S&P 500. We got a bit of a rising wedge, a little bit more pronounced, slightly, than what we're seeing on the S&P 500. Same basic action. We've had a nice move. We go back to take a look at the weekly chart. We can see that we are well above the trading range that we spent the last couple of years in. So again, a pretty productive breakout. And for the moment, things are very bullish. Again, things are looking great. Things are looking like we're ready to climb out and ready to rally and move forward. The real test, again, of course, is eventually we will retrace. And that retracement is critical because if we want to maintain this breakout, we want to hold above this 187. You realize the last time we broke out, we spent maybe a week and a half, 2 weeks trading above that range, and eventually when we retraced, we gave back the ceiling of that price range and came right back and actually traded all the way to the middle of this longer term trading range, right? So what we want to do is continue to sort of make these positive steps and continue to sort of gain ground on the market by retracing higher than the last time, right? So it's the same thing we just discussed with the S&P 500. You don't want to give back ground, right? So you don't want to give back this retracement. We don't want to lose. We don't want to lose this. Give me a second. This thing is not reacting well. Good Lord. All right. So we don't want to lose this retracement. We want to make sure that our next retracement is, well, it's not this far, but really what we want is a retracement somewhere in here, where we don't really lose this 187 to 186 area, and we just pull back, test it, hold above maybe the 50, and then start to climb higher, and continue to sort of make these steps forward and not move backwards, right? You don't want to give up. You don't want to give up the previous retracements that we had. Now again, we had a very short-term retracement here, down to 186. It's not that substantial, so I'm not concerned really if we lose that, although I don't want to because I don't want to see us lose the 187 level. But if we do, as long as we don't come all the way back and retest this 178 and retest this breakout of the last downtrend, or maybe even a little bit lower and lose the 200 in this area, then I think we're fine. And I think ultimately it's still bullish and it's still setting up for a strong move to the upside. Right, so overall things are still very bullish and setting up for a strong move to the upside if we're looking at the intermediate to long-term chart. Now the question again is the same as before. In the short term, how is it looking? Well, it's not looking that great. It's not looking bad. We can continue to climb these wedges and these narrow channels that sometimes rise. They could persist a lot longer than you would expect. If you take a look at the last time we had one of these rising wedges, you'll notice that it lasted from, what is this, January? Basically the beginning of February all the way up to March 6th, right? So it was about a month and a week, or a month and a couple of weeks. And then what we ended up getting was just a 2-day drop, and then it eventually started climbing right back up, right? So that's why I'm saying it's not a good idea to try to short this, because these things can persist for a little bit of time, right? Even you look at the last time we had one of these patterns, it again persisted from April all the way to May, so another month of climbing, right? So there is a chance that this could continue to climb higher, but that doesn't make it a good trade to the long side. And as has been evidenced by the last couple of times that it dropped, it doesn't really make for a good short trade either. I think if we want to short, we want to wait for more signs of impending weakness So maybe when you see a drop and then when it kind of bounces back up and it ends up being a weaker bounce, then maybe you can start looking at trying to decide whether we're looking at a longer term downturn. But I think at the moment, with the move to new highs, with the strength of the price action over the last few weeks, I don't think shorts are something we want to concern ourselves with, because at this point, in order for us to get a good short setup, there has to be a lot more technical damage done to the charts um, that would not be done quickly. Um, Even if we had a big drop down to 178, we'd still need to see a bounce back to resistance before we had a good short trade, right? So I think at the moment we don't want to look at shorts. We want to look at longs, but we don't want to trade longs that are behaving in a pattern similar to what we're seeing in the market. Now, one thing I will point out is a lot of times when the market churns like this, there are individual areas of the market or just individual names that give us better setups, right? And aren't really mimicking what the market's doing, or they're lagging a little bit behind it, or maybe they're a little bit ahead of it. And there are going to be some names that have already moved up and come back and retraced and are retesting the breakout and providing us with better setups. Or maybe are lagging a little bit behind and are still in this process of emerging out of the initial consolidation before they follow the markets upward. And those are the names that we want to focus on during the next couple of weeks. If you are not looking at trading earnings, which is really what I'll be focused on over the next couple of weeks, is trading earnings and working on taking advantage of the volatility patterns that emerge during earnings season. Now, as far as the Qs, really, like I said, the key level is 187. If we lose that, I expect the 50 period to support, but if for whatever reason we had a major sell-off, the key area here is 178. I don't want to see us lose that. If we lose that, then we're likely to come back and retest the previous lows, at which point it's going to become a lot more difficult to really understand what's going on with the price action. We're going to really have to step back and reevaluate before we get more aggressive with trading. But in the short term, that's not what I'm expecting. What I expect out of us right now is to probably climb a little bit higher in this wedge. And eventually when we lose that wedge, I think I want to see the nature of that drop and see whether we just hit the 20 and start to climb like we did back in March, or does it turn into a more substantial retracement? And if so, does that retracement hold above 186 to 185, or at the very least above the 50-period moving average? And if so, then it continues to show that we're gaining ground on being able to push through this trading range that we've been stuck in for a couple of years now. And again, what we really don't want to see is a mirror image of the breakdown, right? We don't want to see us climb up and then come back and just surge right back into the middle of this trading range. I think that would be a negative. What we want to see is continue to make these little incremental moves above the previous range and continue to just maintain price action above that area that we've spent the last couple of years trading. As long as we do that, then that means the next move up is likely to lead to even new to more highs and higher price action. Now, as we move towards the Dow Jones, you'll notice again, same sort of price action, new all-time highs just a couple days ago. Now, we don't really have a rising wedge on this one, right? If anything, we had a more shallow wedge that we broke out to the upside. So it seems like the Dow Jones over the last few days has started to show some relative strength. It did show relative strength a few weeks ago that eventually sort of faded. So I'm not really sure what to make of it yet, but I do want to point out that the Dow Jones is starting to sporadically behave stronger for short periods of time. So it could be that there's more money flowing into these names than we're really aware of at the moment. So keep an eye on some of these Dow Jones components. See if they're starting to show some potential moves to the upside. And if so, you might be able to get yourself a couple good trades that are maybe moving a little bit ahead of the curve of what the market's doing. Now, despite that, I think that even though we don't have the same rising wedge as the last two indices we just looked at, the idea is still the same, right? We're going to likely pull back at some point soon. When we do, we want to maintain price action above 268. If we look at the weekly chart and see where we stand in the bigger picture, we're just starting to peak up and out above our previous range that we spent the last couple of years in. You can see the Dow Jones, for the most part, has been restricted to a range on DIA between 267 and about 234, 235. Now, we did have the brief surge below last year, but for the most part, all the trading action has been sort of pinned between this 268 range and again the 234 to 235. We're now peaking out above it. We're trying to maintain price action above it. And again, it's very reminiscent to what we saw from 2015 to 2017. You'll notice again the same sort of idea. You spend a good portion of time trading in one range. We had a false breakdown. Eventually kind of came back up. And then once we finally were able to push past that range, we had to spend a few months trading above it and sort of confirming that buyers were willing to accept these new price levels. And that's what we're doing right now. We're starting to explore higher, but we still need to make sure that buyers accept these levels and are willing to confirm that they are now considered value as opposed to considering them as too expensive and they turn into an area of supply. And I think that's really the key here. That's how these price ranges work. Is you need buyers to accept a new price range, right? What's happened over the last few years is to sort of simplify it a little bit and not get too bogged down in technical analysis, looking at different candles and whatnot, is look at what buyers or the attitude of buyers and traders are, right? For the last couple of years, 235 has been considered a good value, right? It's been considered a buying the Dow Jones at a discount. 265 to 269 has been considered a bad price. It's considered overpriced, right? This is where people think that the Dow Jones is not worth that. So what happens is when you have these prevailing attitudes, you're going to have a lot of buyers that buy it when they think it's a good value, which is 235, and you're going to have them sell it when they think it's overpriced, which is around this 265 to 268 area. Now, eventually, you digest enough where you find enough liquidity, enough demand to push through that range, right? You get enough of a shift in sentiment where there are enough buyers that now think this is worth more than 268. And when that happens, that's when you start to explore higher. Now, what we need now is for the market to come to a consensus and decide this is now a good value. This is a good price. This is no longer, 235 is a pipe dream now. We're not going to get back there. The idea now is that if you want value, you're going to have to settle for 268. You can't look at 235 anymore because that road is long gone, right? And that's the attitude that you need to see shifting if you expect the price to start moving higher, right? So that's where we stand right now. Is we've started to find enough buyers to explore higher, thinking it's going to go higher, but we haven't reached a complete consensus where the buyers that like to buy on the drop are going to buy here, saying, well, this is value now. This is where we want to get if we want to buy the Dow Jones on a discount, right? So that's the sort of the process that's going on right now. It's not a process that's going to be concluded in another week or two. It's probably going to take another couple of months where we see price action continue to find support at these areas. And if we find enough support there, then we're going to start to climb higher. And that will sort of be, again, the mirror image of what we saw back in 2017 before we began the rally that led to these price levels to begin with. Excuse my coughing, by the way. I'm kind of getting over a cold. Now, if we do pull back and we can't hold above this 268 to 267 range, well then the next area is the 50-period moving average, which is starting to climb upwards. I think as long as we bounce above that, it's still indicative of price action trying to hold above this range. And again, it's showing that we're still moving forward and we're not retracing all the way back to our previous retracement, which again led all the way down to 247. But I think the key area again is the breakout of this red trend line, which is right around 255. As long as we hold above this, which is now the 200-period moving average, I think overall price action is still leading forward and is still positive. But ideally, we don't want to really come back into that range anymore. I think we want to hold above 268 to 267 and try to maintain price action above our previous range if we want to continue sort of mirroring the price action that we saw from 2015 to 2017. Now, the last one we're going to look at is IWM, and this of course is a completely different picture. We go to look at the weekly picture. You'll notice again, we're nowhere near all-time highs. We're still well within the range that we've spent the last few years in, and are really not even at the upper edges of it. We're still in the lower half of that range, right? So we're still seeing a lot of weakness with the small caps. Unfortunately, this has been a common theme throughout the last decade or so. So at this point, I don't consider it to be an indictment on the rest of the markets. I think that we can rally without the small caps pushing to new highs. I'd really like to see them all moving together, but that doesn't look like it's going to be the case again. Now, you'll notice we don't have a rising wedge either. So even in the short term, relatively speaking, we're weaker. We actually have a little bit of a descending triangle, showing that there still is more bearish pressure on IWM as opposed to what we're seeing on the other three indices. Now, I think ultimately what I want to see out of IWM, and of course our expectations have to be different for this than what we're seeing out of the other three indices, but I want to see us get above this 158 range. This was a very critical bearish turn of events on the small caps, and this occurred when the rest of the markets were all pushing to new highs, and it was starting to look like a pretty positive move, and it looked like IWM was going to play some catch up and really start to rally and follow the footsteps of its peers. But that ended up not being the case. Instead, we had a very big surge to the downside, and which led all the way back down to the bottom of our major sort of trading range that we've had over the last couple of years. Now, we were able to break past it and start to climb higher, but we've been climbing kind of slowly and really haven't been that productive with it. And you'll notice we've been sort of maintaining this upwards trajectory for the last couple of months now, and we're starting to lose that, right? So overall, in the short to intermediate term, we're starting to see more weakness creep up in IWM, and we're starting to see, again, signs of weakness as opposed to strength in what should be the area of the market that we would see strengthen. Typically, when we are starting to break out to new highs, when the market is starting to get aggressive, traders are going to look for upside potential. And where are you going to find that? Well, you're going to find that in the more volatile assets, which tend to be the small caps. And we're not really seeing that. We're still seeing traders being sort of fearful, having one foot in the pool, one foot out as they sort of test the waters. And the foot they always take out is the small caps. And again, that's been an overall arcing pattern for the last 10 years or so. And until we really see a shift in that, it's kind of hard to get full on behind a strong rally. You'll notice that the times that we had strong rallies in the market, the small caps did participate, even if they were a little bit different in nature. You'll notice back in 2017 when we eventually broke out of the market, the small caps were trading very close to all-time highs, and eventually were able to participate in the rally and climb higher. And that was also the case way back here in 2012 to 2013. The small caps did participate in the run to new highs. And at the moment, we're not really seeing that, right? The small caps aren't really ready to push to new highs. And this is kind of one of the warning signals we have, telling us that maybe we need to spend more time consolidating at the top of that range before we're really ready to embark on a new rally like we had in 2017 or like the one we had in 2012, 2013, 2014. So at the moment, what I want to see is I want to see the small caps get back above this 158 and start to play catch up and start to get back towards the upper edge of that range. Now, if that were to occur, then it could be something similar to what we had back here in 2017. You notice when we were looking at the other three indices, this consolidation range was above the previous one, right? So if we why is this doing this? Give me a second. Alright. You take a look at this range that we spent on IWM, just basically from 2014 to about 2017. Compare that to the S&P 500, right? You'll notice that when we were consolidating before we had that breakout in 2017, we were holding above pretty much the entirety of that range. With IWM, we were actually trading underneath that range, right? And we were kind of consolidating just below the ceiling of it. if we were to really mirror and kind of copy what we did back in the beginning of, or the end of 2016, beginning of 2017, well then we'd need to see IWM trading up here, somewhere between 160 to 170, and kind of consolidate just below those highs, and then eventually climb higher as the rest of the market started to really ramp up and start rallying strongly to the upside. Now, again, this is all within context of looking for a major rally, right? We could continue to kind of slowly climb higher and just inch our way upwards little by little without the small caps participating. But I think if we want to see a rally with the strength of what we saw in 2017, or even reminiscent of what we saw back in 2013 to 2014, then we probably need the small caps to participate. And if that was the case, then I think the first thing we want to see is we want to see us get above this 158 and start trading in the upper edges of the previous trading range, and at least kind of hold below the ceiling and build up momentum for a breakout and to follow through and kind of chase the price action that the other indices are sort of already leading ahead with. That's not really what we're seeing right now, right? As a matter of fact, what we're seeing is a loss of momentum in the other direction. Again, you can see that we are starting to sort of violate this ascending trend line that sort of has at least given us some positive momentum over the last month and a half. And while I don't think it's a big deal that we're starting to lose this trend line, as long as we don't really fall back and start to lose these three big moving averages, the 20, the 50, the 200, I think we're okay, again, because we have become accustomed to seeing this weakness on the small caps. So if we lose that a little bit further, it's not a big deal. But ultimately what we want to see is we want to see us maintain price action above the 200 and start to get back above 158 and start to explore some of this territory, at which point I think we can get behind a lot more of a bullish move on the stock markets, and we could be more aggressive about trying to trade to the long side. But until we see that, we have to assume that the markets are going to have a little bit more trouble than what it would suggest by just looking at the charts of the S&P 500, the Nasdaq, and the Dow Jones. So I think this is where we can maybe keep an eye out for warning signals to the downside. I'm still more concerned with the price points that I mentioned in the other three indices over what I'm seeing out of the small caps and out of IWM, but I don't want to see us lose these price points either, right? And ultimately, we don't want to lose 148, and we don't want to lose 145, which is really the key. If we lose that, then I think that's very negative, and that would likely mean that the other indices are going to have to come back and fall back into this range that we've spent the last couple of years in. And I think it will be indicative of us not being ready to move past it, which would likely lead to several months of trading in this trading range and sort of being mired back in a neutral price environment. So we do want to see a change in character here if we want to get behind this idea of a stronger market rally coming in the near future. So that's the four major markets put together. I do want to point out that ultimately, even though we ended it kind of on a negative note with IWM, I think overall the price action is very positive right now, and I think it's hinting at a pretty strong move to the upside. I don't think we're there yet, but I think that there are signs that we're setting up for a strong rally to the upside. And I think maybe we'll see what happens as we move forward through earnings season, whether there's enough of an impetus for us to continue to make some positive moves through some of these technical levels and continue to sustain price action above these really broad trading ranges that we've spent the last few years in. Let's take a quick look at the US dollar, oil, gold, and silver, and then we'll move on to the chart requests. If anyone here has a chart request, I'd love to see what you're looking at. It could be a chart that you're trading actively, or it could be one that you just have a question on a pattern. It could be that you're looking to figure out what your targets are, or even if you should stop out at a certain level. Anything like that, just feel free to type it into the chat box, and I'll go ahead and take a look at them in a minute. So if you look at the UUP index, and you look at the US dollar, interestingly enough, despite the fact that we've been discussing this, the idea of lowering interest rates, the dollar has still started to show some signs of strength. And was able to break through this descending trend that had started to develop since May, basically. Now, we're still sort of downshifted as we're still below this trend or this channel that we spent a good portion of 2019 in. So it looks like we kind of were climbing, and then we kind of downshifted a gear. And now we're climbing again, the same trajectory, just a little bit lower. And if that's the case, that's still pretty bullish for the U.S. dollar. But I do want to point out that we're also starting to see a rising wedge here as well. If you use the bottom of the previous channel and then this trend line, you can see that we're starting to get price converging as it starts to climb upwards, which typically leads to a move down, not up. So we're seeing a little bit of conflicting messages here on the U.S. dollar. I think a lot of that is indicative of what we're seeing in the euro, where we are starting to see signs of both bullish and bearishness at the same time, which is going to lead to mixed price action and is going to lead to tricky trading. So what we want to see right now is a resolution of one of these patterns. Either we continue climbing back into the previous channel, more importantly, we break through this 2635 to 2640 barrier, or we fall through this ascending or rising wedge and start to head back lower and start to test a little bit lower. I'm in favor, I think, of a move back down. I think I'd rather see the U.S. dollar come back and test 26 and kind of break through these. That's more what I'm anticipating. But I'm waiting because I think at this point it's kind of a coin flip. If we take a look at the euro, U.S. dollar, which again is going to be inverse of the UUP index because this is priced in euros, we'll see that again we're having a little bit of a mixed message here where we have a pretty critical level of support that we're holding above, but we're losing some of this short-term momentum to the upside. So we have some bearish and bullish developments at the same time. Again, we also had a bullish development as we broke through this strong trend to the downside. We were able to retest it and hold and start to climb higher. And we haven't gone backwards yet as far as breaking below our previous retracement, even though we came very close to it. So overall, I would say that this is both positive and negative. And I think we need to see a clearer move in one direction or the other before we can really say that it's going to be a clean trade to the upside or the downside. So I think at the moment, I'm not looking to actively trade the U.S. dollar. I'm not looking at actively trading the euro-US dollar cross as well, because I don't see anything here that really favors a good move long or short. I think that we're likely to bounce here, but it might not be a strong bounce because we're now on the wrong side of this short-term trend line. And I think if we do continue to drop, it's not really a good short trade as well because we have a lot of upcoming support levels just below this key area, just right around 112. So I think it's going to be difficult to trade this long or short right now. I'd rather stay away from it. We look at the US Canadian. Now this is actually kind of bearish. We've lost a lot of significant ground. We lost the previous lows from this inverse head and shoulders. And at the moment are still sort of just making our way down. My mouse is acting up today. I'd probably just say it's like this. It's just a channel. And overall, while this is bearish, I'm also not really that excited about continuing this short because it looks like we're starting to reach a point where we're trying to find a bottom and trying to break through this channel. So I need to see a failure at the top of the channel before I'd want to go ahead and try to short this as well. And I think at the moment, again, this is something that is indicative of a consolidation range, but until we emerge from that, I don't think that there's really a positive trade to take. So not interested in that as well. And the yen again is a little bit different. And again, showing just the mixed nature of the US dollar right now, where we're seeing completely different pictures across the board as we look at these different currency crosses. Now this one actually has a little bit of bullish sentiment to it. We were able to break through this bearish move, and we found some support and have a new uptrend starting, but overall we're still really stuck in a consolidation range as well. And until we can really break through that, it's going to be difficult to go ahead and take a trade in either direction. And I think, again, the key here is to watch as it breaks through this range in one direction or the other, and that'll give us a clearer picture of how to trade. So that's what we're seeing out of the US dollar. I think overall, again, it's a pretty mixed bag, and giving us giving us a little bit of a difficulty trying to figure out where to go next. And until we see a clearer picture here, I think it's better to stay away from the U.S. dollar. Now, despite that, gold and silver have actually shown some strength. Gold in particular had a nice little short-term bounce today, or break up. And looks like it wants to climb and retest its previous highs. Overall, the gold trade has worked out very well and has continued to behave very well over the last couple of months. Silver, not quite as much, but you can see recently, over the last 3 days, has really started to show some strength. Now, overall, not quite where gold is. You can see we're not really back up to our previous range or above it like GLD is. But overall, starting to show some signs of positivity and doing something. This is basically what I want to see out of IWM, which is eventually to play catch-up and start to catch up with its stronger peers. And that's really what SLV has been the weaker precious metal compared to gold, and has kind of been lagging behind for a while now. But starting to play a little bit of catch-up, which again bodes well for gold, as it's starting to show that there's more momentum to the upside across the board with these names. And then finally we have oil, which again, positive and negative, just like the U.S. dollar. We had a pretty strong move to the downside that we were able to break past, but we faded it all back and are right back into this range and really just struggling. The one positive for oil is that it has maintained price action above this 55 range, which was kind of a major trading range for the last several years. And it's at the moment struggling to maintain price action above its all its moving average, which is converged right around this one spot. If it can get back above here and rally back above 58, then I think that's a good long signal, and it's worth trading to the long side. But it needs to do something. I wouldn't just buy it here guessing that it's going to hold. As a matter of fact, it hasn't held. It actually broke below all those key moving averages. But if it were able to get back above it, I think that would be an okay long signal. If it doesn't, then we need to wait. It might make its way all the way back to 54 before it finds support. And as you can see, it is losing. It is losing what was a very nice convergence of support, or potential support, between all the moving averages and this little short-term ascending trend line that's developed. But it's on the wrong side of all of that. So for the moment, it still looks like it wants to head down. If it were to kind of turn and move back above it, then I think that'd be positive, but it's not there yet. All right, so that's gold, silver, oil. Again, if any of you, there's not many of you in here today, but if you have a chart request, feel free to put it in. We have a good 10 minutes or so. I do want to point out again for Ray, Kirkland Gold continues to climb higher. This was a nice gold name that has done really well. There's been a lot of gold miners that have done really well recently, and have been a good area to trade if you were having trouble with some of the stock market. Now, we did have a couple of trades on my Patreon page that have done decently for us. One of them is Spotify, which had a really nice breakout from this triangle. Now, it did fade and we did get stopped out already, but we got a nice move off of it. If you think about it, from 147 all the way to 153 or so, 150. It actually made its way all the way to 156, but I didn't take anything off there. I took it off up here at our previous range around 154. It's a very nice move for us. It was a very good move, and it did pull back. There could be a case made to still be long this, but because of the nature of the market, I've been very quick to take profits on names once they start to retrace on me. And I think that's maybe what the attitude that you should be having as we continue to watch this market is. Just be quick to take profits as you have trades to start to head up into resistance levels, because the risk reward's not great right now in the markets. And if we do pull back, you're going to see a lot of names across the board pull back. So for the moment, I'm being pretty quick about taking profits and not holding names too long. I don't think we're at a spot now where we want to worry about the momentum trade. I think we're getting close to where we can start looking at momentum trades and holding names for extended periods of time. But at the moment, we're not there yet. I think we're still in a sideways environment where we are looking to take advantage of quick bounces while the market realigns itself and tries to set up for a longer term move to the upside. Now, one last example I want to point out is a trade that we did not take and why we didn't take it, and that's XRAY. This was a trade I posted on Monday as a possible trade, but what we were looking for was a move back above 57, and that did not occur. At least not a sustained move that gave us an entry signal, and because of that, we ended up having to kind of hold off on that trade. So this trade is an example of why you need to have a trigger point before you go ahead and enter a trade. There was a couple of... Give me 1 second. All right, so when we were looking at this trade, and again, this was a few days ago when it was still really hovering around this 57 point, you'll notice that this is another one of these names, a lot like what we're seeing in the overall markets, that has a bullish and a bearish pattern. We had a nice move to new highs, and then we had a nice retracement in a nice orderly fashion, and it's still really in the midst of that. However, we also had a double top, right? You had a move up to 59, a bounce back to 57, a move back up just below 59, then a move back to 57 and below, right? So we actually have a confirmed double top at the moment, and we're in the process of confirming that with a breakdown below 57. So if we come up and we can't break past 57, this is going to lead to a move down further, right? However, if we can break past 57, then it shows a failed bearish move, which would have led to a likely strong move to the upside. However, that hasn't occurred yet, and at the moment it's becoming more difficult to take because our risk reward has gotten worse as price action has eroded below that 57 point. It's all the way down to 56 now, which means we have $1 of risk for maybe $1.50 to $2 of upside before we get back to the previous highs. So at this point, it's become more difficult to trade, but a lot of traders, when they see a post like this, they're like, well, I'm going to go ahead and get in ahead of time because I don't want to miss the move. And what ends up happening is they ended up trading a bearish pattern, thinking they're trading a bullish pattern. And the truth is that this wouldn't have been a bullish trade until we were able to break past 57 and move through it. We didn't really get that, which led to a non-trade. And I think sometimes that's kind of important, is understanding that you don't always need to take trades. Sometimes the best skill you could have is avoiding trades, and avoiding trades that are going to get you into trouble. Now, ultimately, this could still trigger and could still lead to a move to the upside. But as far as the parameters we were looking at on Monday, that was kind of negated with yesterday's drop. And I think at this point, it's one that we need to see a little bit more before we go ahead and want to trade it. But I just wanted to point out why this trade why it wasn't taken, and why it didn't actually trigger, and why I set up the parameters the way I do, and why I mentioned in the trade idea that what we want to do is see a move back through 57 is because we want to see a negation of that double top, and we want to see price action trapping bears that were trying to get short ahead of time. And instead what's happening right now is that buyers that got in ahead of time are the ones that are trapped. And we'll see now whether this heads a little bit lower, or if eventually we do get enough buyers to push past through. But just wanted to point out why we look for triggers and why we want to see a break through these trend lines before we go ahead and enter these trades. Okay, and I think that'll conclude today's stream. I'm going to try to. I recorded this, so hopefully I'll be able to upload it to YouTube, and anyone that wants to look at the kind of review this again can go ahead and find it, and anyone that missed it will hopefully be able to see this in the near future. Hope you guys have a good rest of today and the rest of the week. And again, be careful with earnings season. Make sure you pay attention to what names are reporting during what days so that you don't get caught up on volatility that you weren't anticipating. Other than that, have a good rest of the week, and we'll meet again next Wednesday.